Hi, welcome back. Today we're looking at something that's been catching the attention of investors all over the country, and honestly, it deserves the attention. Silver has been on one of the strongest runs we've seen in years, and now people are asking a question that would have sounded almost unrealistic not too long ago. Could silver actually outperform gold from here and make a serious run towards $70 an ounce? That's what we're going to unpack today, calmly and clearly, without hype, without fear, just the facts laid out in a way that actually makes sense. Let's start with why this matters right now. Gold has already had a remarkable run, grabbing headlines and pushing to levels that surprised a lot of people. But there's a quieter story happening underneath that headline, and it's the story of silver starting to close the gap. When silver moves faster than gold, it usually means something is shifting beneath the surface of the market, something that touches industrial demand, investor psychology, and even the basic math of how much of each metal actually exists. Understanding this shift isn't just interesting for the die-hard metals watcher, it matters for anyone who cares about protecting the value of their savings, understanding inflation, or simply making sense of where money is flowing in this economy. So let's break this down from the beginning. Gold and silver have always moved together in a general sense, but they don't move for exactly the same reasons. Gold is mostly a monetary metal. Central banks hold it, investors buy it as a store of value, and it tends to respond to things like interest rate expectations, currency weakness, and geopolitical uncertainty. Silver carries that same monetary identity, but it also has a second job. It's an industrial metal. It goes into solar panels, electric vehicles, electronics, medical equipment, and a growing list of technologies tied to the modern economy. That dual identity is exactly why silver behaves differently than gold at different points in the cycle, and it's exactly why the current setup looks unusual. Here's what this means in practical terms. When investment demand for precious metals rises, both gold and silver tend to benefit. But when you layer heavy industrial demand on top of that investment demand, silver gets pulled from two directions at once. Factories need physical silver to build solar cells and circuit boards. Investors want physical silver as a hedge against a weakening dollar and rising uncertainty. Both of these groups are competing for the same limited above-ground supply, and that competition is a big part of what's been driving prices higher. Now, this is important because silver is a much smaller market than gold. Think about it this way. The total value of all the gold ever mined dwarfs the total value of all the silver ever mined, even though silver is used in far more industrial applications every single year. That means it takes a lot less new money flowing into silver to move its price significantly, compared to the amount of money it would take to move gold by the same percentage. Some analysts call this the smaller pond effect. A boat that barely creates a ripple in the ocean can create real waves in a small lake. Silver is that small lake, and right now a lot of boats are showing up at once. Let's talk about the gold to silver ratio, because this is a concept that helps explain a lot of what's happening. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has swung between roughly 50 to 1 on the low end and over 100 to 1 on the high end, depending on the era. When the ratio is high, it often signals that silver is undervalued relative to gold, and history has shown that these wide gaps tend to narrow over time, sometimes sharply, as silver catches up. We've been sitting at elevated levels on this ratio for a while now, and the recent price action suggests the gap may finally be closing. That doesn't guarantee anything about the future, but it does explain why so many market watchers are paying closer attention to silver specifically, rather than just precious metals in general. To put this in everyday terms, imagine two neighbors who normally spend about the same amount on groceries every month. One month, one neighbor's spending suddenly jumps far above the other, without any clear reason tied to their actual needs. Sooner or later, people start asking questions, and often things drift back toward a more normal relationship between the two. That's a simplified way to think about how these ratios tend to behave over long stretches of time. It's not a rule carved in stone, and it doesn't move on a fixed schedule, but it's a pattern that's shown up again and again throughout market history. And it's part of why so many long-term investors keep an eye on it. Let's shift to what's actually driving this rally on the ground. On the industrial side, the build-out of solar energy infrastructure continues to expand across the country and around the world, and silver remains a critical component in photovoltaic cells because of its unmatched electrical conductivity. Electric vehicles use more silver per unit than traditional combustion engine cars, largely due to their electrical systems and charging components. And the broader push into artificial intelligence infrastructure has increased demand for silver in high-performance electronics and data center hardware. None of these are speculative trends. They're already happening, and they require real physical silver, not just numbers on a screen. On the monetary side, the Federal Reserve's interest rate decisions continue to play a major role in how investors think about precious metals. When interest rates are expected to fall, the opportunity cost of holding a metal that doesn't pay interest becomes smaller, which tends to make gold and silver more attractive compared to holding cash or bonds. At the same time, ongoing concerns about the purchasing power of the dollar have pushed more everyday investors and larger institutions alike to look at precious metals as a way to preserve wealth over time, rather than simply chasing short-term speculation. Now, let's bring in China, because this part of the story doesn't get talked about enough. China is both one of the largest consumers of physical silver for industrial use and a major participant in the global silver trade through markets like the Shanghai Futures Exchange. When Chinese industrial demand rises at the same time global investment demand rises, it creates a kind of squeeze on available supply, because the same ounces of silver can't be used for solar panel production and sit in an investor's vault at the same time. This is one of the quieter forces behind recent price strength, and it's worth understanding because it shows that this isn't just a story about American investors buying coins and bars. It's a global competition for a genuinely limited resource. Before we go further, if you're finding this breakdown useful, take a second to like the video and subscribe to the channel. It genuinely helps more people find this kind of clear, no-hype explanation of what's happening in the markets. And we've got a lot more of these breakdowns coming. No pressure at all. Just wanted to mention it while we're in the middle of this. Now, let's talk about supply, because this is really the other half of the equation. Unlike gold, a huge portion of silver that gets mined every year is actually consumed by industry rather than stored. It gets used in a manufacturing process, and it doesn't come back onto the market in any meaningful way. Meanwhile, a significant share of silver mining actually happens as a byproduct of mining other metals like copper, lead, and zinc. That means silver producers don't always have the flexibility to simply ramp up production when prices rise, the way you might expect from a metal that's mined directly. This structural rigidity in supply is a big reason why some analysts believe the market has been running tighter than official inventory numbers might suggest. There is also the question of how silver moves between different categories of storage. Some of the silver sitting in major exchange vaults is technically available for delivery, while another portion is already spoken for or held under specific arrangements that make it effectively unavailable to the open market. When the amount of freely available silver shrinks relative to the amount of silver people actually want to buy or take delivery of, it can create friction in the market, sometimes showing up as unusual premiums on physical products like coins and small bars compared to the quoted spot price. This kind of premium behavior isn't something that shows up in a headline number, but it's often one of the clearest signs that physical demand is running ahead of readily available physical supply, and it's something worth paying attention to rather than reacting to. Let's talk about where prices actually stand right now. Silver has recently pushed past the $60 level, trading in the low $60 range, which is a level that would have seemed extraordinary just a couple of years ago. Gold, meanwhile, has continued its own historic climb. The question a lot of people are asking is whether silver has room to run further, potentially toward that $70 mark, and whether it could actually outpace gold's percentage gains from here. To think about this clearly, it helps to use a simple mental framework. Picture two runners. Gold has been running steadily for a long time and built up a big lead. Silver has been running slower, but historically, when silver decides to sprint, it can close distance quickly because of that smaller market size we talked about earlier. Nobody can promise when or if that sprint continues, but the conditions that have triggered similar sprints in the past, tight supply, rising industrial use, and a high gold-to-silver ratio, are all present today. Now, it's important to acknowledge the other side of this conversation too, because responsible investing means understanding risk, not just opportunity. Silver has always been a historically volatile metal, meaning its price can swing sharply in both directions, sometimes within a short period of time. If the Federal Reserve moves in an unexpected direction, or if industrial demand cools due to a slowdown in manufacturing or construction, prices could pull back just as quickly as they've climbed. Precious metals markets can also be influenced by short-term trading activity in the futures markets, which doesn't always reflect the underlying physical supply and demand picture in a clean way. None of this means the bullish case is wrong, but it does mean nothing here should be treated as a guarantee, and this video is not financial advice. It's meant to help you understand the forces at play so you can do your own research and make decisions that fit your own situation. It's also worth remembering that markets rarely move in a straight line, even during a genuine long-term uptrend. Sharp rallies are often followed by periods of consolidation, where prices trade sideways or pull back for a while before the next move higher, if it comes at all. That kind of pause isn't necessarily a sign that something has gone wrong. In many cases, it's simply the market digesting a big move, allowing new information to settle in before deciding on its next direction. Understanding this can help you keep a level head, whether you're just watching from the sidelines out of curiosity or you already hold some exposure to precious metals as part of a broader financial plan. Let's talk about what different outcomes might look like from here, keeping things balanced. In one scenario, industrial demand keeps climbing, the Federal Reserve continues moving toward lower rates, and the gold-to-silver ratio keeps compressing as more capital rotates from gold into the relatively cheaper metal. In that kind of environment, a push toward $70 and beyond becomes a realistic possibility over time, though certainly not guaranteed or immediate. In another scenario, if inflation surprises to the upside and forces the Fed to hold rates higher for longer, or if a broader economic slowdown reduces industrial silver consumption, the rally could pause, consolidate, or even retrace some of its recent gains before eventually resuming if the longer-term structural story remains intact. Both of these outcomes are within the range of what's historically happened in metals markets, and staying aware of both helps you avoid the trap of only seeing one side of the picture. So how does this connect to real life beyond the charts and the headlines? For a lot of everyday Americans, this conversation isn't really about getting rich overnight. It's about understanding how the value of money changes over time, and how physical assets, like silver, have historically played a role in preserving purchasing power across generations. When you understand why silver behaves the way it does, industrial demand pulling from one direction, monetary demand pulling from another, and a genuinely limited physical supply caught in the middle, you start to see the bigger picture of what's happening in the broader economy, not just in this one metal. That kind of understanding is valuable no matter what silver's price does next week or next month. Let's bring this all together. Silver's recent strength isn't coming from a single source. It's coming from a combination of rising industrial demand tied to solar, electric vehicles, and advanced electronics, a monetary backdrop shaped by Federal Reserve policy and concerns about the dollar's purchasing power, a historically wide gold-to-silver ratio that's beginning to narrow, and a physical supply picture that simply isn't as flexible as many people assume. Whether silver actually reaches $70, outpaces gold, or takes a different path entirely, the forces we've discussed today are the ones worth watching, because they tell you far more about where this market might be heading than any single headline or price target ever could. Thanks for sticking with me through this one. If this breakdown helped you understand silver's current setup a little more clearly, consider subscribing so you don't miss the next deep dive, because there's a lot more happening in this space worth understanding. I'll see you in the next video.